Hi again. I just wanted to go over some basics regarding the stochastic indicator as shown here below in the charts. Now usually I work from TradingView, but sometimes I switch back to I place the trades on the MetaTrader 4, so I'll show it to you from the MetaTrader 4. This is a platform that most Forex traders use, so this is where I started with. So it's easy to refer to. I think a lot of people can relate to this. I do suggest TradingView in general, though. It's by and large just easier to scan through the charts with. But okay, so let's start here as far as the trade that I took. The trade that I took, the one that I'm referring to, is this one here. So it's the latest gold trade based on several factors, not just the stochastics. And this, although I tend to look for divergence, in this particular case, I wasn't looking for divergence on the stochastics. Unless it happened to show up, that would make an even more high probability trade. But first of all, I was looking for my points of resistance on the 4-hour. And the trend line that I extended from these 2 points all the way up, which again you can see here met with the support zone here. So there was a confluence between the trend line and the support. Now to back it up, to make it an even higher probability trade, that's where the stochastics come in. So really stochastics take on a secondary or tertiary role. So I was looking to make sure that, I mean, you could see probably given the price action that this was a good entry in the sense that not only was it hitting the support and trend line, but it had come down pretty low. But I wanted a good, quick visual interpretation of that, and that's what I use the stochastics for, to make sure that it's in this case an oversold zone, and it is. So if it's below the 20 mark here in the stochastics, that usually is an indicator that it's oversold. But I always like to check the higher time frames. So I also referred to the daily time frame here, where you could see, it's harder to see here, but the stochastics here at the point I took the trade were not overbought. And now if it was, preferably I would have liked to have seen even the dailies down here somewhere in the oversold region. But as long as the higher time frames aren't in the overbought region, then I still consider it a good possibility. And then I also zeroed down to the 1 hour time frame. And again, notice here when I took the trade, which is right at the bottom, notice here that the stochastics on the 1 hour were still pretty low. So I like to zero in definitely, obviously, on the 4 hour, but then even further down in the lower time frames, such as the 1 hour, to make sure that it's also, in this case, if I'm taking a long, that it's oversold for the shorter term time frames as well. Now, if I'd waited, and I didn't, I got in really at a good point here. I got in also, just so you're clear as what was prompting me to look at this entry region here. I was also looking for a round number at around 1720, so it met that criteria as well. Now, if I had waited a little bit longer, I would have gotten a divergence here on the hour time frame. That would have been another indication that it's a higher probability trade. Now, just so you know, I don't base my trades solely on the technicals. They help me plan an entry. My basic criteria for actually looking at a market in the first place are the fundamentals. Now, given obviously the conditions, the climate that we're in, gold, I think in general, is a good play to the long side. As long as you can catch it at these points where it's oversold and it's hitting the longer term trend lines and support. So anyways, that's some of the ways that I use the divergence indicator. the stochastic indicator. I'll get more into how I use the stochastics in combination of divergence in my later videos. I've already made one on that you can refer to. I think I'll go into a little bit more detail just to help clarify things for anyone who's interested. Thank you. Have a great day.